p.m. live from our studio in New York City. I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. The odds of a soft landing may be rising. An upbeat jobs report plus the monthly reading on consumer sentiment showing signs that inflation is cooling off. The news driving the S&P 500 to near its highest level of the year. We're going to break down the numbers and what the data means for the Fed ahead.
Plus, a medical breakthrough. The Food and Drug Administration approving the first ever therapy using gene editing, and it's for sickle cell disease. We have the CEO of one of the companies behind that therapy straight ahead.
And deal chatter, it's driving up shares of Paramount Global. A report says that Sherry Redstone's National Amusements controlling stake may be up for sale. We've got the latest developments coming up. Let's get you up to speed on the market action right now. When it comes to equities, we do have this rally going on for the major averages. Energy, which has been one of the losers of the year, coming back today. That group is up about 1%. Tech also strong. That's leading the Nasdaq higher by about 0.5%. The S&P 500 up 0.4%, as is the Dow, gaining about 140 points today. Staples and utilities, though, are weak. And of course, we continue to pay a lot of attention to what's going on in the bond market as well today. We've got yields that have been turning around, right? Lately, we've seen a big pullback in yields. Listen, they're still low compared to where they were a month ago, but still 4.24% here, an 11 basis point move to the upside. Pretty sizable in the wake of the economic data we got today.
Yeah, look at the yield on the 2-year, by the way, about 15 points. I'm looking at 4.73.
Yeah.
Big move. Americans are feeling increasingly better about inflation. Consumers expect inflation to sit at 3.1% a year from now. That's a big decline from last month's 4.5%. That's according to the latest consumer sentiment survey from the University of Michigan. Yahoo Finance's Josh Schaefer joins us to break it all down. Josh.
Pretty good vibe in the economy right now,
That's
right?
all
Little
I
Josh, and I feel like that fits the vibe that we got from some of the data today. A little upbeat Friday, right? And it really, you saw the markets turn up on this inflation reading here for consumers, what they're expecting. And I think that's because you saw the lowest number since March 2021, 3.1%. Pretty low, obviously, considering last month they were expecting 4.5%. Now, this is obviously based off inflation data that we've already kind of seen, right? They're digressing the CPI data and the PCE data that markets had already taken in. But I think overall, when you think about sort of what the consumer sentiment data normally means, is it's a good sign for the Fed, right? Because you want people to feel like prices are coming down.
Well,
Jerome Powell talks about that.
I mean, prices are self-fulfilling, as we
Right.
know, both to the upside and the downside. If you think prices are going up, you're going to be willing to pay higher prices. If you think our prices are going down, then consumers are going to put a lid on what they're willing to spend and keep prices down.
Right. And so you want people to believe that inflation is actually going to be coming down, especially when you look at this survey also does the long run inflation, right? 5 to 10 year. That was at 3.2% last month. That's down to 2.8%. So in the long run, people also see inflation coming down, which again, overall just good for the outlook. And then I think broadening this out, and we think about the labor data that came out before the market opened and we didn't see stocks up, then we saw this sort of combined with that to create this nice little soft landing narrative for us. Yeah. You've got jobs still growing, right? Like, yes, the labor market's cooling, but overall people are still employed. 3.7% unemployment rate. No one would argue that that's not incredibly low. And inflation coming down. That's what the Fed wants, right? They want us to be employed and they want us to pay less for things, Josh. That's the overall goal here.
I think the point you brought up too, Josh, because you're kind of spinning ahead, because people are starting to think about what does actually consumer spending look like in 2024, which was interesting because when you kind of sifted through all those earnings reports, right? And I mean, I think that was really a theme was not recession, executives weren't talking about that, but again across multiple sectors and industries, you heard, well, we're getting more cautious about the consumer. But then to your point, Josh, you look at, this relatively positive sentiment reading, you look at the jobs report, jobs are growing, wages are growing, inflation's cooling, and you begin to understand why investors are starting to think, it's rare, it's tricky, but maybe the Fed sticks that soft landing and consumer spending is actually sort of okay next year.
Yeah.
We're sort of, or not sort of, I was just going to point out too, we're still far away from that, right, too? And I think that's the other takeaway we need to have from today too is, yes, we're talking about soft landing today. You have an inflation print on Tuesday, and we could be talking about a hard landing, right? And you have a Fed meeting on Wednesday, and then like things can start to move quickly here too. And that's one of the things that a lot of economists were warning about today. Yes, soft landing right now, but you still have people projecting the unemployment rate might go up to 4.5%, and then these kind of sentiment readings will shift a lot, right?
Just to, Josh, just to put the numbers you were giving us in some perspective, I thought it was interesting. Peter Bookfor, well-known, economist, strategist, mensch, really. I think we can say. Peter pointed out to his clients that the index is still 30 points below where it stood in February 2020 because that 20% pop in the cost of living is measured by CPI. And that was just kind of interesting because we talk a lot about, the numbers are better, but sort of the doom and gloom kind of feeling that some people have. Interesting perspective.
And we're significantly off the pandemic lows too, right?
Yeah.
So now we're kind of in this middle ground of can we get back to what it was before the pandemic?
Normalization. That's been the word for a while. All right, Josh Schaefer, thank you so much. Well, the first ever gene editing therapy approved by the Food and Drug Administration, it's called Casgevy, and the companies behind it, Vertex Pharmaceuticals and CRISPR. Joining us now is our Anjali Kamlani, as well as Vertex Pharmaceuticals CEO, Dr. Reshma Kewalramani. Thank you so much for being here, both of you.
It's good to be here.
Anjali, take it away.
Thanks so much, Julie. Of course, we know that the drug is, or the cure rather, the treatment is the first to be approved. The FDA did approve both Bluebird's as well as Vertex and CRISPR's gene editing for sickle cell today. And we do have, of course, Dr. Reshma Kewalramani with us today. Dr. Kewalramani, thank you for joining us. And I want to just ask you, first of all, momentous occasion. We know so much has been built up to this point. The accolades have already been won. Talk to me about now this next chapter for the treatment and sort of the long-term follow-up that is needed to just see how it works.
Well, thanks so much for having me on, Anjali. It is a huge day in science and medicine, and it's a particularly important day for patients with sickle cell disease. So what this medicine is, Casgevy, is the first CRISPR-Cas9 gene editing based therapy for sickle cell disease. And what we do here is take the patient's own cells, their own stem cells, to our labs. We edit the cells and we give them their cells back with the defect corrected. And what the studies have shown is that patients who undergo this therapy have no more of these painful crises called VOCs, veno-occlusive crises. Patients describe it as a Mack truck going up and down on their bodies. Patients describe this as worse than childbirth. And the studies show us that patients undergoing this therapy, it's a one-time therapy, no longer have these veno-occlusive crises to deal with. It is an amazing technology. The seminal papers were written just in 2012. The Nobel Prize was awarded for this discovery in 2020. And here we are in 2023 with an FDA-approved product for sickle cell disease patients.
Absolutely. And we know, of course, this one-time treatment requires multiple steps to get to the finish line, but the reward, of course, being not to have to worry about this disease. We know that the short-term look at it has brought on the approval for the FDA with, of course, on the label, a look to the future. As we get more information on this new technology, how confident are you that the future holds no concerns of off gene editing or any other concerns that you might have?
As a medical doctor and as a physician scientist, we always have to be humble. We have to be aware and we have to follow our patients over the long term. That being said, and we will be doing that, we will be following our patients over a many-year period. This is a very precise gene edit. It's a durable gene edit. And all of the data that we've seen to date, including long-term follow-up as long as up to 4 years, tells us that this is a therapy that is incredibly effective. And we have seen no safety concerns in terms of this concept of off-target editing. We simply haven't seen any of that.
Well, that's wonderful. I know that you've already set the price tag for that a little bit lower than the other gene therapy that was out there. You've had these conversations with the government and payers. Talk to me about the value that you see there and why this price tag and what you see moving forward, if any potential changes.
The price tag for Casgevy is $2.2 million. And remember, that is for this one-time therapy. As we think about the price, it's always about the value that our medicines bring for patients. And in this disease, it is a devastating disease. It is a life-shortening disease. And when you think about the cost to the healthcare system over the lifetime of a patient with severe sickle cell disease, the kind of patient who would be eligible for our therapy, that number is between $4 and $6 million, not including the humanistic burden to the patient or their families. And we've priced the medicine to be able to bring this incredible value, this one-time therapy for potentially a lifetime of cure. And we want our medicine to be accessible to as many eligible patients as possible.
Definitely the focus on that, as many patients as possible. We know that this disease does have a specific demographic. There are minorities in particular that are largely affected. Do you anticipate this price tag being a burden? And do you have any plans in place for access in case someone is unable to pay for it?
One of the reasons that I'm so very proud of this Casgevy approval today is because sickle cell disease and the sister disease beta thalassemia affect Black and brown people. And these have been diseases that have been largely ignored for many, many years, both in terms of the healthcare system and in terms of drug development. We have done a lot to make sure that not only do we have a first-in-class medical therapy, but that we have done everything to make sure that this is a therapy that's accessible to patients. So the way that this drug works is that you need to have it administered in an authorized treatment center or an ATC. We've already activated 9 of them. Most of our patients with sickle cell disease live in 25 states, and we very thoughtfully organized to make sure that these ATCs are in the states in which our patients live. With regard to the reception of this therapy by patients, physicians, payers, governments, regulators, anyone who touches a patient with sickle cell disease, the enthusiasm level has been high, and there are indeed payment paths in place, and the conversations have been going on for well over a year, and I feel high confidence that patients in the U.S. will have access to Casgevy.
Absolutely. Well, certainly a historic day for science, as you mentioned before, and certainly for this new technology that we know is this is just the beginning. So congratulations again, Dr. Reshma Kewalramani, CEO of Vertex. Thank you so much again for joining us.
Thank you so much.
Sale of its security business to Honeywell for nearly $5 billion. So this one, interesting, Julie, because you've had some changes in the C-suite relatively recently. You got a new CEO there, took the reins over the summer. So a big, obviously, historic move from him here as he looks to kind of broaden Honeywell's product offerings here. Got some financial information on the deal as well. Predicts revenue more than $1 billion, it looks like, for the combined security services business. When you look at Honeywell, it hasn't been great for those investors this year. It's down about 10%. Though, it's fair to say, too, they do have plenty of fans on Wall Street. Most covering this name are bullish. Yeah,
that new CEO, Vimal Kapoor, has talked about doing M&A. He's been very explicit that that's been one of the things that is part of his goals. And some analysts saying this was a very logical acquisition for Honeywell to make this security business from Carrier. Some analysts, though, pointing to that this is maybe a little bit higher. It's good for Carrier, but not as good for Honeywell, maybe a little bit of a high price. What's interesting, too, is it's also creating a bit of a ripple effect. Allegion, for example, which is a competing business to that carrier security business also caught a bid today. Maybe some speculation that there's going to be some other M&A in the business. By the way, what does this business do? We talk about security business. This is not like a cybersecurity business. They make electronic locks for big companies, among other things. And it's going to go under Honeywell's building automation segment. They have customers that are big industrial customers, hospitals, airports, things like that. So that's where it sort of fits into Honeywell. All right, let's talk about MBIA right now. Those shares are soaring. The move on an extraordinary cash dividend of $8 per share. That'll be paid out on December 22nd. This after one of MBIA's divisions paid it an extraordinary cash dividend. And I have to say, this caught my eye for a couple of reasons. One, it was on our trending ticker page. And two, I haven't talked about MBIA in a long time. It sort of had a big role during the financial crisis as a mortgage insurer that, like so many companies at that time, perhaps took on risk it shouldn't have. So I haven't seen this name in a second, right? So that was interesting, too, to see it for that reason. But interesting that these shareholders are going to get this extraordinary dividend. There's also the company, I guess, has talked in the past about potentially selling itself.
Yep. An interesting analyst comment here, too. There was a good note from Roth MKM. They actually downgraded the stock to neutral following kind of this dividend news. And I think the money quote here was when they told their clients, while we expect the company to eventually be sold, the timing of a sale is nearly impossible to forecast, as is its eventual sales price. So they moved to the sidelines. Looks like analysts have 1 buy, 2 holds, 0 sells.
Yeah, not very covered, though, at this point in time.
Limited coverage at this point. And finally, let's end here on shares of Qorvo. They are rising after an upgrade from Morgan Stanley. And so this was actually kind of a broader note. It looks like kind of made several ratings changes. On Qorvo specifically, yes, the stock's up about 15% this year, but in part he's making a valuation call here, the analyst saying, look, yes, it's had that bump. In his opinion, it still looks attractively valued. Valuation still constructive. Sees really solid kind of earnings growth ahead. Talking about it's kind of just smartphone-linked chip companies, talks about the momentum in Chinese Android phones and content gains linked to 5G.
Yeah, as part of this call, Stephen Moore over there at Joseph Moore, over at Morgan Stanley, also downgrading Qualcomm as part of this call and downgrading Lam Research to equal weight from overweight. But overall, he talks about turning more positive on the device side within the chip universe, although it's interesting, one would think of Qualcomm being in that category, but I guess they're a little more diverse than that. But he talks about the inventory correction within devices running their course. So, he's lowering his view, though, on semiconductor capital equipment to cautious from inline, which explains the Lam Research downgrade. But, of all the industries we talk about, I mean, a lot of them are going to be interesting in 2024, but chips in particular, because of what's going on with AI, because of questions about where we are in both the device and the PC cycle, it's going to be really interesting.
And even if you're not in chips, listen, if you're just investing, I mean, strategists are always quick to point out it's chips that lead the market on the way up and on the way down. So you want to pay attention regardless of whether you have money put to work in them.
Yes, that is an excellent point. We're just getting started here on Yahoo Finance Live. Coming up, we're tracking the major averages, trading slightly higher today, but on track to snap a 5-week win streak potentially. And a new installment of our series, Goodbye or Goodbye. We're going to look at 2 magnificent 7 stocks and tell you which one's a buy and which one you should say bye-bye to. Shares of Paramount, meantime, resurging on more reports of a potential M&A deal for the media giant. We're going to give you the details on that story when Yahoo Finance returns. The jobs report, of course, coming in better than expected with 199,000 jobs added. The unemployment rate unexpectedly falling to 3.7%. Joining us now is Julia Pollack, ZipRecruiter chief economist. Hey, Julia. So we've had the benefit of some hours now to digest the numbers here. As you've had time to sort of percolate on it, what's your big takeaway of sort of where we are in this employment cycle?
So it was a mixed report with a huge household survey and a weaker, a narrower establishment survey. I think the overall takeaway is that the picture remains intact. The labor market is slowing. So that 199,000 number should really be quite a bit lower because 35,000 of those workers were just people returning from strike. That puts the underlying rate of growth at around 160,000, which is exactly in line with the 2019 average. The labor market is all the way back to pre-pandemic normal.
And Julia, let me ask you about one metric there. It's getting a lot of interest, that an unemployment rate ticking down to 3.7%. Just walk us through, Julia, what explains that? Did that tick down for all the right reasons?
Yes, it ticked down because of new entrants coming in, but this is a volatile measure. The household survey in general is a volatile survey that showed more than 700,000 people coming to work in November. A huge employment increase, which we know is just statistical noise, right? Last month it showed 300,000 people leaving employment, and so it's important not to focus on one number. Overall unemployment has been around 3.7, 3.8% the last couple of months, give or take.
One of the numbers you were looking at as well, not to pick on another individual number, is aggregate labor income, which is the number of employees working times the hourly wage. Their working hours, that is, times the hourly wage. And there we saw growth of about 8%. So that's hourly workers working more, making more per hour, if I'm reading that correctly. What does that imply about sort of lower income hourly workers?
Yeah, so it's grown 5.3% year over year. It's grown 9.1% in just the last month on an average annualized basis. That's very strong. Right before the pandemic, it was growing 4.6% year over year. So when you have that amount of income going into the economy, labor income, even if consumers are seeing their access to consumer credit decline, it's not going to have such a huge effect on overall consumer spending because it's going to be offset by the resilience of the labor market. And I think that bodes well for companies going forward, even though these interest rate hikes are really biting, right? They're holding a lot of companies back. They're holding people back from buying homes. They're having quite a severe effect on many, many markets and industries. There's sort of a floor under that effect because the labor market is still so resilient.
And Julia, I'm interested in just the impact of strikes or the end of major strikes. How did that impact this report, and what do you think it means for the December report?
Sure. So in this report, 96,000 people were absent from work last month due to strikes, and this month that number fell to 61,000. A more normal number in this report is 10,000 a month. In recent months, there had been a lot of strike activity, and the number was hovering around 30,000, which was pretty remarkable and high historically. So this is still a time of a lot of labor action. These acute labor shortages after the pandemic, paired with this huge surge in inflation that left many workers behind when it comes to real wages, have caused workers to organize and fight to be made whole.
And Julia, let's look ahead a little bit to 2024, because you say we're on the verge of another sort of roaring 20s, if you will. It does, that's not kind of what the rhetoric I think that we are hearing would sort of indicate. So what does that mean to you, roaring 20s?
So the original 20s were a time of huge innovation, growing well-being and wealth, largely because of a transportation revolution, a power revolution, right? Households and factories got electricity. They got cars, they got tractors, and it was off to the races. Well, this time we have two huge innovations that are also creating very exciting prospects in the labor market and across the economy: a green energy revolution and also AI. So another productivity enhancing innovation there. There will be some differences. I think we'll avoid the crash that ended the last roaring 20s, which was a result of very low interest rates that fueled speculative mania. We got the crash out of the way at the beginning of these 20s, and we're going to have probably higher interest rates for the foreseeable future that will put some restraint on that kind of activity. But companies are in a good position now with strong balance sheets, with these microchip shortages easing, with supply chain difficulties working themselves out. And when the Fed does start cutting rates, I think we'll see a flurry of activity.
And Julia, so I'll get you out of here on this one. We got through that jobs report. Julia, what's the next big economic indicator you're going to be looking for? Is it November CPI, for example?
Absolutely. All eyes will be on inflation. I think the jobs numbers are not really going to sway the Fed that much one way or the other. It's the inflation reports that are really the ones to watch to figure out the path of interest rates going forward.
Julia Pollack, thank you so much for joining us today, Julia. Appreciate your time.
Thank you, Josh.
And shares of Paramount Global, they are soaring today, up more than 12% as reports continue to swirl regarding potential M&A deals for the media giant. It's according to Deadline. Private investment firm Redbird Capital and production company Skydance Media are looking to acquire the voting shares of National Amusements. National Amusements is the holding company which controls Paramount through its Class A shares. That's headed by Sherry Redstone. Yahoo Finance's very own Alexandra Canal has more. Allie.
Hi, Josh. Yeah, a really interesting deal if this were to come to fruition, because acquiring those National Amusement shares would essentially allow both Redbird and Skydance to control the company without having the need to purchase the companies. And that'd be beneficial because it's likely that both Redbird and Skydance, they're not interested in cable. They're not interested in the legacy media aspects of Paramount. They're interested in the studios. They're interested in the IP. So this could allow them to offload some of those undesirable assets or perhaps find a strategic partner. Again, just a report at this point, both Paramount and National Amusements declined to comment to Yahoo Finance. We have not heard yet from Skydance and Redbird, but National Amusements as a holding company is interesting since it owns approximately 10% of Paramount's equity capital value, but maintains 77% of those voting shares. And that's valued at around $1 billion, although analysts have said that that does not account for what could be, quote, meaningful control premium. So the potential for those shares to be valued even higher. We heard from Wells Fargo analyst Steve Keyhall, who laid out several options that we could see if this deal were to come to fruition. One could be the combination of Skydance with Paramount's existing studios. We could possibly see the shutdown of streaming service Paramount Plus, and again, the possible spinoffs of some of those assets like Pluto and those linear TV legacy elements there. So, whenever you hear Paramount and a potential breakup, you see the share price rise because this is a company that's really been in the news about this for a while.
Exactly. So you would think people kind of learn their lesson and not bid up the shares.
That's every time.
Okay. So we have overall, though, seen it's been kind of slow in the M&A space for media. So any glimmers, or is this a signal that there's going to be a pickup next year?
There's certainly a lot more chatter than there has been, and experts that I've spoken with have said 2024, particularly the back half of 2024, you might see a little bit more of media M&A, and that's due to a few factors. One, the fact that consolidation just needs to happen. The consumer is even telling us that it needs to happen. The strikes, the resolution of both of those strikes is also a sign that we have more clarity when it comes to the economics here, when it comes to overall strategy. Of course, there are some risks with interest rates being high, but by and large, 2024 is looked at as the year of more media M&A. There's a lot of capital on the sidelines, especially from the private equity space, that could be deployed. And when we think about Paramount in particular, it's prime target for M&A due to its small size. I mean, $11 billion in market cap. You compare that to Disney's $170 billion. Netflix has $199 billion. It's a company that you could really see sell off a lot of those parts. There have been those rumors about Showtime, BET. They did offload that Simon & Schuster publishing business. So, we haven't seen a ton of activity there with Paramount, probably because of Sherry Redstone not wanting to do that. This could be a way that maybe we see some of that come to fruition, but we'll have to see next year.
Sounds like you're going to be busy.
Yeah, you're going to be busy.
Thanks, Allie. All right, coming up, we've got a new installment of our series, Goodbye or Goodbye. We're going to look at 2 Magnificent 7 stocks and tell you which one's a buy and which one you should avoid. That's next. It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye, brought to you by E-Trade from Morgan Stanley. Our goal to help cut through that noise to navigate the best moves for your portfolio. The so-called Magnificent Seven have dominated the equity market this year. Each of them has risen by at least 50%. So is it too late to get in on the action? And if not, which one should you buy? And by the way, which one should you avoid? I'm here now with Jay Woods, Freedom Capital Markets Chief Global Strategist. Thanks for being here. Really appreciate it.
Great to be here.
So let's get to your good buy, first of all. Your one you are buying. We're talking about Amazon in this particular case here. So that's your good buy. Let's talk about some of the reasons why you like the stock. And since it's you, Jay, no surprise.
Shocking.
You're starting with the technical. So I'm going to call up a chart here of the one-year performance of Amazon and talk us through what looks good from a technical perspective.
Well, over the last year, it's just gone in a nice straight uptrend. There we go. And it continues to trade at 52-week highs. You mentioned at the top of the show that stocks in the Magnificent Seven are up 200% in the case of NVIDIA, and some are lagging, only up 45%. Only up 45%, and Amazon just happens to be one of those stocks. And Amazon, what we like to do in technical analysis, when in doubt, back it out. So what I have next is a 5-year chart. Now let's look at this in perspective. Where were we at the beginning of 2022? We were right at this level. What did we just do? We just broke out at this 145 mark and just made back what we lost over the last 2 years. So we've come roundabout, but we haven't made new highs. I think it's set up not just to hold this level, but to go back and challenge the new highs like we've seen in other Magnificent Seven stocks like Microsoft, NVIDIA, Apple, and Meta.
And is that what tends to happen when you see this kind of activity?
Yeah, this is what we like to call a nice rounded base with a cup and saucer handle. I think Sarge did this on Wednesday for everybody. So when you see this pattern and it break out and it has something to reverse, and then you look at the story overall, to me, the setup is there for Amazon to be one of the best stocks performing-wise in the Magnificent Seven for the next year.
Okay, so we looked at it from the technical perspective. Let's talk about what else here. The PE ratio, the price-to-earnings ratio. Now, for Amazon, it's what, in the upper 60s?
It's 67.
That sounds high, but you have to look at history.
Exactly. Historically, Amazon has always had a high PE ratio, and I'm not a PE ratio kind of guy, but for a Magnificent Seven stock, it has the second highest PE of the 7, and that's what we're talking about. So when someone says, well, it has a PE ratio of 67 and Apple's only at 31, Microsoft's in the low 30s, NVIDIA is just under 40. Well, historically, 67 is at the 5-year low of its average. So I would throw that out the window if a skeptic says, well, the PE ratio is too high. I look at the technicals first, the fundamentals second, and then third, I think we're going to talk about some of those.
Yes, let's talk about some of the other fundamentals, right? Let's talk about how Amazon's fundamental business is doing. How is it doing by your estimation?
Well, if you drive home and try to get through my neighborhood, it's doing quite well. The vans are everywhere you go. But we saw strong Cyber Monday and Black Friday sales. That's good. And then they just made an announcement this week about pivoting with their Whole Foods acquisition. Remember they acquired Whole Foods like 5 years ago? Yeah, well, now for $9.99 a month for those Prime subscribers, you can get unlimited deliveries for $9.99 a month if you pay over $35 or more per delivery, and I think in New York we're safe to say that. So they're expanding in the food business, and I think that is a setup. And then we haven't even talked AI or cloud or AWS. Just from a delivery standpoint, they continue to compete. They continue to eat everybody's lunch and dinner in this case because they're having it delivered and they're eating it too. So the stock is hitting on all cylinders.
Gotcha. Okay, so as always, we like to talk about what could maybe go wrong with your bullish thesis here. And in this case, you're looking at maybe, there are some questions about consumer spending going into next year.
Yeah, the macro environment, I think, is what's going to cloud Amazon. And right now, I kind of like the macro environment, so it's hard for me to say that there's going to be a pullback. You have the technical, you have a good risk-reward setup as a technician, as someone that's trading the stock. Okay, if it breaks back below the 50-day moving average, maybe get out and wait. But if the macro environment does slow down, if the consumer starts to pull back, then maybe we'll see a shift in sentiment towards the way people use Amazon. But right now, they've already shifted down the next step, which is buy now, pay later. And we're seeing it with Affirmed, which you can use Affirm when you now go to Amazon and shop. Instead of paying that credit card and that 28 to 30% on the credit card, you buy now, pay later. So those are the risks if the consumer pulls back, if there's a twist in the economy we don't see coming. But right now, I think it's pretty safe to buy over the long term.
And before we get to your goodbye, just quickly, you're long Amazon?
I have no position, but I would tell my mom to buy it. And if I can tell my mom to buy it, then I feel comfortable.
Okay, fair enough. All right, let's get to your goodbye. And this is one of the most divisive, I think, on the street, especially in the Magnificent Seven. We're talking about Tesla. And here, too, I think we're going to start with the technicals, right, when it comes to Tesla. So I'm just going to hop right to this one-year performance.
Yeah, and the technicals are showing us what? We had a nice rally in the beginning of the year, and now what do we have? A consistent downtrend. And what we don't see in this chart is the gap from earnings. As we came into last quarter's earnings, price actually led. Price broke down before they reported their quarterly report, and then we had the sell-off. It's making its way back. Now, this is a horrible downtrend line. My finger really doesn't do it justice. But the stock over the long term is still in a downtrend. Yes, it's up 97% for the year. It's been phenomenal, but look where we were coming from. It had one of its worst years in 2022. It made a lot of it back. But unlike the other in the Magnificent Seven, it hasn't made it all back. It's still 20% off of its 2022 peak. It's 40% off of its all-time high. And it's struggling to find that next catalyst to take it higher.
Well, okay, so is the next catalyst...
Well, there's our 5-year chart.
We'll look at this chart real quick, and then
Yeah.
we'll get to the next.
Okay.
So we'll talk about this chart real quick.
Well, what we want to do is look at the long-term effects. And like I said, it's 20% off of its 2022 high, 40% off of its all-time high. It does have room to reverse, but it's consistently making higher lows. And that, to me, is a little concerning. And then you look at this, if you want to round it out now, once again, my finger not doing the greatest charting here. It looks a little toppy to me. It's broken key weekly moving averages, and that is concerning.
Okay, so let's get to the next thing then, and that's the Cybertruck.
Yeah.
You were disappointed by the Cybertruck? You didn't think it was awesome?
It looks like something I made in Cub Scouts at Pinewood Derby back in those days, but besides my personal disappointment in how it looks, the rollout has been delayed, and that has been a consistent problem with a lot of Tesla's products. It's a lot of hype, a lot of people excited about what's coming. But the Tesla Semi, we were going to, trucking was going to change. They've only rolled out one. The Cybertruck, the rollout was less. And then when they rolled it out, it was supposed to be 500 miles per charge. It was 340 miles per charge. And then the cost was much more than they anticipated, between $79.9 and $99.9. That is not going to bode well for a consumer that has a strong appetite for Elon Musk and his products. There's no denying that. But right now, the rollout isn't there, and the more it's delayed, the more the stock could struggle. Yeah,
there's more talk, more demand maybe for a mass product, which we're not seeing yet from Tesla. And then let's talk about earnings from Tesla. What have you been seeing there?
Well, they've missed 2 of the last 3 quarters, and that's a little bit concerning. Last year, they were supposed to have about $6 EPS over the year 2023. It came in about half of that. So that is a trend that you don't want to see continue. So to me, that's concerning. And then on the earnings call, when someone who I respect more than anybody, Dan Ives, who's one of the biggest Tesla bulls, says that earnings call was a quote-unquote disaster.
Yeah.
That's got my antenna up. Now, Dan is much more bullish on it and thinks the stock is going to rebound, and I hope it does. I really do. But right now, there are more concerns than positives, and this is one that I would avoid for that reason.
What could go right for Tesla?
Well, Elon Musk. I mean, how can you ever count on Elon Musk? I hate that I'm criticizing this stock in this segment because, one, you're going to get killed on Twitter for it. That's just what happens with Tesla. And two, I am a big believer, and the cars are amazing. But right now, the rollout continues to be slower, but Elon Musk always pulls something out of his hat. Whether it's...
Sometimes it's a good thing, and sometimes it's not.
We're waiting for self-driving cars. If we can get those self-driving cars, then boom, that we're going to see a huge jump in it. But every big, discovery, every next thing, it keeps getting delayed, and people are getting tired of hearing these great promises and not getting results as he tries. Maybe he's too concerned about other things. And then the other concern is, does he have to sell more shares of the stock because of his X and Twitter problems? So we'll see.
Question. Just quickly, position in Tesla?
No position in Tesla.
No position in Tesla. Okay, so Jay, we're going to sum up what you have told us here today. You would buy Amazon based on bullish technicals, including recommendation for Jay's mom, a PE ratio that is historically not high compared with Amazon's own history, and solid fundamentals. On the other side, you're saying avoid Tesla based on its bearish technicals, some lackluster updates on new and upcoming vehicles, including the Cybertruck, as well as a downtrend in earnings. Jay, thank you so much.
Thank you.
Third episode here of Goodbye or Goodbye. Thank you so much for watching. Of course, we're going to be bringing you new episodes 3 times a week at 3:30 p.m. Eastern. Tune in on Monday. We'll be right back.
Bank of America downgrading PayPal and Toast this week. PayPal shares under pressure after Amazon announced it will no longer use Venmo for payments. Meanwhile, Bank of America is citing slower top-line momentum and increasing competition for Toast downgrade. For more on the payment sector and Bank of America's top picks for 2024, we turn now to Jason Kupferberg, Bank of America's Senior Equity Research Analyst. Jason, thank you so much for joining us. And I actually just want to start maybe higher level, Jason, because as you point out, it's been kind of a rocky couple of years for a lot of names in the payment space. Maybe, Jason, just for our audience, for our viewers, could you explain sort of broad strokes why that is and what the sector needs to do to kind of get out of that rut?
Well, first of all, thanks very much for having me. It has been a really tough couple of years, and there's a couple of reasons for that. One being some of these companies really flourished during the pandemic and really had trouble adjusting to the post-pandemic normalization of consumer behaviors. Another reason would be a lot of macro concern about the health of the U.S. consumer. Were we going to go into recession? Were we not? What are consumers buying? Discretionary goods, non-discretionary goods. And so all of these cross currents created a lot of consternation for investors, and I would say that these concerns were really a combination of cyclical and in some cases structural. In other words, shifts in the competitive landscape, who was gaining share, who was losing share. So now let's look forward to 2024. What can possibly get this sector out of its rut? We identified a couple of potential dynamics that could do just that. Number one, greater visibility on forward estimates in 2024. And along with that, what we're talking about is really increased confidence in a soft landing scenario. Now, that's the base case that Bank of America's economists are calling for. And we think that as we go through the year, to the extent that confidence builds in that scenario, then people will be more comfortable with where forward estimates are, and therefore they'll be comfortable putting a higher multiple on those estimates, and hence we could see appreciation that way. Industry M&A is a possibility. We did see a couple of transactions in the second half of 2023. If there's a pickup in that activity in a more stable interest rate environment in 2024, that could be a catalyst. And then the third would simply be potential investor rotation out of other subsectors, either in tech or in financials. Payments kind of sits at the intersection of those two industries. So those are really the three factors that we're looking for in 2024 to break payments out of this rut.
Hey, Jason, I'm also curious when you talk about sort of the secular or structural changes that we're looking at in the industry, I'm curious about the effect of buy now, pay later. I mean, when you talk about the competitive landscape, that's been part of it. Some of the companies that you talk about do that, but then there are some pure plays too. How has that sort of changed how these companies operate and how they do?
Some of our companies have definitely made a bigger play into buy now, pay later. Now, on the pure play side, we do cover Affirm, and Affirm's mission has been buy now, pay later at its core from day one. Then we have companies under coverage such as PayPal, which about 3 years ago launched their own buy now, pay later service. And we also cover Block, formerly known as Square, who, as many of you probably know, made a big acquisition of a company called Afterpay, which was a pure play buy now, pay later provider. They did that acquisition almost 2 years ago. So what we are seeing is some shift in consumer preferences. We are seeing in a certain consumer demographic, this isn't for everyone, but for a certain consumer demographic, the flexibility of being able to expand your purchasing power, particularly in the case of a 0% APR offer, definitely has its appeal. And we think buy now, pay later is a payment method that is here to stay.
And Jason, I just want to touch on some other picks as well. Names, PayPal's interesting because it's been a tough stretch, obviously. So it's down about 17%, Jason, this year, but you went from buy to neutral, so you're going to the sidelines. So you see some challenges ahead in 2024?
Yes, we think 2024 is a transition year for PayPal. We have a brand new management team here, a new CEO, a new CFO. They're both coming from outside the industry. We don't have any issues with the initial high-level plan that the new CEO set out about a month or so ago, but we do think it will take time to execute on this plan, to see true benefits of that plan to the financial metrics that matter most for PayPal, which are branded TPV growth, as well as transaction profit growth. We think the improvements there could be kind of gradual rather than a steep inflection higher, hence the stock could be relatively range bound. And we also recognize that the competitive environment just does continue to get more and more intense. But to be clear, we don't think PayPal is a broken story. It still has a very strong brand and balance sheet.
And just to follow up on PayPal, I just want to ask you about a headline, Jason, because we talked about it on the show this week, and it got some attention. Amazon telling Prime users that Pay with Venmo would no longer be available for checkout. Listen, you know the name, Jason, so I'm just interested to get your take for PayPal. Big deal, no deal. How did you see that?
What we said in our note yesterday on this topic was that this will not result in any kind of material, direct financial impact. We believe the reason why the use of Pay with Venmo on Amazon is being discontinued is because it simply did not gain user adoption. It had been in market for a little bit over a year, and it was decided that it just was not getting enough traction. Now, with that said, from a sentiment standpoint, it's not a great piece of news because historically, part of the growth story at PayPal, particularly from a longer-term perspective, has been the prospect to monetize this Venmo asset. And the notion of being able to use Venmo to make purchases at merchants is definitely part of that equation. And Amazon, when it was originally signed, was thought to be a marquee customer in pursuit of that goal. And now this takes a little bit of the shine, if you will, off of that opportunity to really monetize the Venmo assets. So it's a little bit more from a sentiment standpoint as opposed to a direct near-term financial hit.
Jason, thanks so much. Great stuff heading into 2024 in the payment space. Appreciate it.
Thanks for having me.
Let's get over to our Jared Blickery now. He's got an update on the latest market moves as the trading week comes to a close. Hey, Jared.
Yes, it was an exciting beginning for gold, and haven't heard much about that since Monday. And let's just check out what the yellow metal is doing today, down about 1% or so. This is a 10-day look, and on the open on Sunday evening, we got that spike to a record high, but it was quickly sold. In fact, this was the biggest day. Monday was the biggest range day in several months, and unfortunately, it was down to the downside. Let's take a look at the year-to-date chart. You can see this is pretty much a sideways trending chart, although we are ending at the highs of the year, or at least in that little window there. Let me show you the last 5 years, because gold has been consolidating in a relatively tight range for quite some time here. And when it finally breaks above, and I say when, it could be if it finally breaks above, it should have momentum that is comparable to the size and the length of this consolidation period, which is to say it could go much higher for a long period of time. However, we have not found that catalyst just yet. Lots going on this week with interest rates. The yen kind of blew up in a small little way, but I've also had my eye on crypto. Let's take a look at the 7-day. This is a 7-day look at Bitcoin up 12%, Ethereum up 9%. Some of the smaller tokens that have been decimated that were last year, Solana, for instance, up about 15%, Cardano up 37%. But let's just chart the price action in Bitcoin. This is a 5-year chart. Now, these are the record highs in here, and we are finally entering the territory where we spent a lot of time, and there's a lot of price memory from 2021 and a little bit of 2022. But you take a look at the momentum. Let's take a look at a 2-month chart here. Simply skyrocketing. This market doesn't want to consolidate and have these down flags that you usually get when you have a consolidating market that's in an uptrend. We're consolidating and still going up. Suffice to say, there's a lot of momentum behind this, and I would be surprised if we didn't go considerably higher. It's going to be rocky, but the momentum is definitely favoring the bulls now.
All right, Jared, thank you so much. Appreciate it. And coming up, closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
We are just minutes away from the closing bell, and I want to take a look not just at today, but where we have been this week, because it's been this 5 straight up weeks for the major averages. Is the Dow going to make it to 600? it's kind
Just
of
there.
Yeah, it's kind of a photo finish here where we look at it. So we'll see if the Dow ends up finishing higher on the week. The S&P 500 a little more comfortably there, up just 0.1% this week, but still it is a gain. And the Nasdaq, the best on the week, up about 0.2%. But you and I have been talking a lot about what's been going on in the bond market. Here it's been a very interesting week because even with the big move upward in yields today, it's still 100 basis point or 1% decline, excuse me. But we've seen a big decline in yields over the past week.
Yeah, you looked at the 2-year as well. I mean, that was up about 14 basis points to like 472. I mean, I do think, you saw you got the positive sentiment, positive jobs, and there were some traders who were thinking, these bets we were making that Jay Powell was going to cut, maybe we got a little ahead of ourselves.
Yes.
That explains some of the movement you're seeing.
It explains some of the movement, but still, if you look at the past month, right, it has been, it's a blip here. And then just quickly, also wanted to look at the sectors. Here they are on the day. If you look at the sectors on the week here, energy, the big loser, along with the drop in energy prices and materials as well. Consumer discretionary, communication services, and tech are the ones that have led us higher, which explains why the Nasdaq is the best performer for the week. And there we got the closing bell on Wall Street. As we look at this probably up week, we'll see where the Dow ends up ending things when all is said and done here. But it has been interesting here to see the moves in energy prices and commodities driving things this week. Things ending the day higher in terms of the major averages here. The Dow up about 130 points. That's almost 0.4%. The S&P and the Nasdaq finishing higher by about the same amount here in terms of gaining about 0.4%. So those are the closing stats here today. I'm taking a look here. Let's see if we've made it for the Dow. Just looking at some of the numbers that Jared Blickery sent me earlier, it looks like we're going to finish higher on the week for the Dow if it does hold at this particular level. 36,245 was the number that we have to close above. And it looks like we are going to get there by the skin of our teeth.
All right, let's get to some tickers here, too. The U.S. Food and Drug Administration approving 2 gene therapies for sickle cell disease. The FDA approval covers a treatment from Bluebird Bio, as well as the first gene-edited therapy from CRISPR Therapeutics and Vertex Pharmaceuticals. I thought it was interesting, Julie, to listen to our colleague Anjali Kamlani just earlier in the show with that great interview with the CEO of Vertex. That was, what struck to me is it has to the price. I mean, a one-time treatment, I believe she said about $2.2 million.
Yes.
So that does bring up, as exciting as that headline is, perhaps it does bring up questions of just accessibility and how many people with that disease are going to be able to afford it.
Yes, exactly. There's a lot of talks right now about what insurance is going to cover. Is it going to cover it? So that's part of the issue. It's also a treatment that is very difficult physically. People who do it also have to use chemotherapy. There are concerns about whether it will alter genes in other areas, so that's a concern. And then if you look at Bluebird and that 40% plunge, its drug, Lyfgenia, is actually priced higher, $3.1 million, and it was approved with a black box warning. What does that mean? It said patients on that treatment have to monitor for the rest of their lives for blood cancer because there had been occurrences in people who had received that. So I guess the takeaway is, obviously, when you look at sickle cell disease, it is enormously painful and disruptive.
As the CEO of Vertex pointed out.
Exactly.
Yeah.
On the other hand, these are not perfect treatments, whether you're talking about price or some of the, things that are necessary to get the treatment. But it is a step forward, at the very least, it seems. Let's talk about Micron here today as well. It's striking a union deal for construction of its Idaho chip plant. It gives the semiconductor giant a chance at receiving a subsidy under the CHIPS Act. That has a preference for companies that make union agreements. The share's up 2% today. It's basically, the CHIPS Act says, if you got to get this before you get funding as part of the CHIPS Act. So that's why this is seen as a positive step. And I believe, if I'm not mistaken, we have not seen, even though there's a lot of these chip plants planned around the country, we have not seen many of these labor agreements as of yet.
Yeah, to your point, the Commerce Department, they want to see applicants strike these kind of construction agreements with unions. It is always interesting when you talk about this news, too, because clearly, listen, the United States government has decided we really want to build out kind of our own domestic chip making. And these plants to build and fill them, they are enormously expensive. I mean, you really can be talking about $15 billion. But it's always so interesting, Julie, because that's really only half the battle. Then you have to staff them, which brings up way bigger questions about education policy, immigration policy. I mean, it takes an enormous 360 effort to really make this happen.
Reskilling, getting people geographically where you want them to be, where these plants are being built. But I remember when the CHIPS Act was announced and some of these measures, these preferences were announced, it was somewhat controversial, or at the very least the Commerce Department was getting some questions about this, but they were very firm that if they were going to go for this funding, it had to be under their conditions.
And Micron sounds like it's on the way.
Yeah, definitely.
And finally, let's check out shares of Lululemon reversing earlier losses to hit a record high in intraday trading. Company beating third quarter earnings estimates, while its outlook for the fourth quarter missed expectations. So we broke those earnings yesterday, Julie, when they crossed the wire. And that was just it. You saw the stock take a bit of a tumble there, and it was on that guide. And now it says that we've kind of reversed there. It is impressive also because remember the stock heading into the print had been on a tear. It was up 40%. But there was disappointing about the forecast. Although if you pour through the analyst notes, at least some of the analysts, and again, they're very bullish on the street about Lululemon. They love Lulu. They said they weren't that surprised by the guidance initially, just given the macro uncertainty, they said, given some of the lack of visibility this early in the holiday season. And maybe it turns out, after thinking about it, some investors agree.
Yeah, it is interesting to see that turnaround. The CFO, Megan Frank, did talk on the call and said that they were happy about their Thanksgiving weekend sales, but at the same time that they were being prudent with planning for the remainder of the quarter. The quarter ends in January. But to your point, there is just an enormous amount of bullishness here. And it's so interesting to see the stock at a new record high at a time when we're talking about concerns over consumer spending.
Oh, for sure. Yeah.
We also
that aspirational consumer in particular.
Yes. I think that we also have talked a number of times about how the higher end consumer has been keeping things afloat, right? You've seen some, when we talk about the choices consumers are making, being more discretionary with the purchases, a lot of that we're talking about a mid to lower income consumer. Lululemon tends to cater to a higher income consumer. Maybe it's not quite a luxury product, but it is that cohort. And clearly they're still willing to spend there. Yeah.
All right, switching gears, let's talk about the road ahead for EV adoption in the U.S. It is littered with bumps and potholes. For many Americans, EV prices still too high, and concerns over vehicle range and charging present real problems. But one analyst sees these headwinds shrinking in the years ahead. We're joined now by Stephen Gengaro, Stifel Managing Director. So, Stephen, thank you so much for joining us. Maybe just start there with the bigger picture, Stephen, because you look at least in North America, there's these signs that maybe consumer demand for EVs waning a bit. We hear, you see these companies, Stephen, they're cutting prices, they're pushing back these $1 billion in EV-related investments. I just be interested to get your take, at least here in North America again, the U.S. particularly. How do you see the EV market right now?
Yeah, thanks for having me. So, as you mentioned, adoption of EVs in China and Europe is north of 25%. Last year, the U.S. sold about 7.6% of passenger vehicles were electric, and clearly there are some short-term headwinds, right? So even if you take out, the interest rate concerns and the expense that creates for the consumer, the two biggest items on the EV side, right? It's vehicle costs. That's one, right? And that's tied into interest rates, but just clearly vehicle costs are higher. And then second is range anxiety / charging infrastructure awareness. So those are clearly the biggest headwinds. We believe, on the one hand, an increase in model availability from both startup EV manufacturers and legacy OEMs will help. You'll start to see the technology that was designed for some of the high-end vehicles filter down into vehicles that are at price points that more Americans can afford. And then second, on the charging side, the government is just starting a plan to spend about $7.5 billion on the NEVI funding, the National Electric Vehicle Infrastructure funding, which should help on the charging front, right? This is an evolution. This isn't going to happen overnight, and clearly, you've seen some short-term headwinds, but there are several factors that are popping up over the next couple of years, which I think start to ease the road for EV adoption.
And just to drill down on one issue in particular, Steve, I'm just interested to get your take on, interest rates, because I remember Elon Musk on that last Tesla call, he called out higher rates, talked about how specifically that was a challenge for his business. So as you look ahead, and look at the interest rate environment, what does that mean for EVs in 24 in terms of just pricing, sales?
Yeah, it's a problem, but I actually just bought a car, right? You start looking at 7-8% rates instead of zero a couple of years back. It is a big problem. But so there's a couple of things, right? One is clearly prices have come under pressure a bit, right? You've seen, and you mentioned the Tesla's approach to that, right? The second is, there is $7,500 of federal government incentives in tax credits that are coming back to the consumer. That helps, and there's obviously some price points involved in who's eligible, but that helps on the cost side. And then third, and this does tie into overall, vehicle prices, that is going to help as you start to see more moderately priced vehicles available. I mean, it's interesting just from personal experience. I mean, just going down to the local Ford dealership as an example, a year ago they were selling the Mach-E's over list, and then they were selling them out list a couple months back, and now they're calling consumers trying to discount them and get them in the market. So it is a problem in the high interest rate environment, and that's clearly why we've seen a lot of negative sentiment recently around EV sales. But I think the pricing ultimately is what's going to drive sales going forward, and then obviously we'll watch what interest rates do next year.
Well, and of course, there's also just quickly the effect of gas prices, right? We've seen gasoline prices come down. Since you've been covering EVs specifically, what kind of correlation do we see between gas prices and the appetite for EVs? And is there sort of a threshold, a particular price for gas, where you start to see things reverse?
It's a really interesting question, and I think, when you look at this from the commercial side and you start looking at fleet adoption, this concept of total cost of ownership over time is clearly something that the commercial customer thinks about. From a consumer perspective, we can look at the correlation between gasoline prices and EV sales, but the reality is, I think most consumers look at a vehicle purchase, they look at what their monthly lease payment looks like or their monthly financing payment, and that's sort of the number that jumps out. So the vehicle cost itself is really what plays into that, along with interest rates. If you start to look at the savings over the course of a 3-year or 5-year ownership, then you start to see savings that can range from $400 or $500 a year up to $1,000 plus, depending on the model you buy and the vehicles driven. But there's definitely a cost savings, but from a consumer perspective, I don't think that plays nearly as big a role in the purchase decision as it does from a commercial perspective.
And Stephen, let's get into some of these initiations here now with some picks. Rivian, you initiate as a buy here. Stephen, how come? What's the thinking there?
There's really 3 big reasons behind that, right? One is their initial vehicle, which is on the roads now, the R1, both pickup truck and SUV. It's clearly on the expensive side. It is a vehicle which is building brand awareness for the company. You're starting to see sales increase, so that helps. But then there's 2 other big factors, right? One is they have a deal with Amazon. Amazon actually owns about 16% of the stock, but they collaborated with Amazon on the design of an electric delivery vehicle. There's a 100,000 vehicle order there, which is helping. But now behind that, they're starting pilot programs for that electric delivery van with other potential customers. And I think that could be a positive catalyst for the shares over the next year as we get results of that program. And then finally, and I referenced this a little bit earlier, but as you start to filter down to vehicles that are more affordable for most consumers, they have the R2 vehicle, which is a mid-sized SUV, which is the most popular type vehicle in America right now. That starts to hit the production in 2026. I think that's ultimately going to be the driver of high volumes and help boost profitability. So those 3 factors are really the big drivers behind our positive stance on Rivian.
At the same time, whether you're talking about Rivian, which you just spoke about, or Lucid, which you have a hold on, the economics of building EVs has seemed to be really tricky, right? Tesla seems to finally have figured it out, but it took it a long time. So what gives you confidence that Rivian's going to get there, and are you concerned about Lucid not quite getting there?
So there, you mentioned it on the Tesla front, and it's a good point. You know, it's hard. It's harder to build a vehicle than many people think. So that's number one. You need volume, right? Because there's an immense amount of expense which goes into the R&D, the construction of the facilities, getting the production lines up and running. So you need volume flow through. And so when we think about Rivian, what we think about is, A, are the vehicles desirable? What's coming out to the market? So we check mark, yes, that's definitely, we believe that. Two is, how do you start to get margin expansion, right? And right now, even on the gross profit line, they're negative. We think they can get gross profit margins to about break even by the end of 2024. There's a few factors behind that. One is higher volumes. Two are some new technologies they're introducing onto the production lines next year. They've renegotiated some supplier agreements which help with the cost side. So there's many factors here in addition to volume which will start to help push them towards gross profit positive, and then ultimately EBITDA positive probably by 2026. And they have $10 billion of liquidity in place, which I think helps them get there. You mentioned Lucid, and on the Lucid front, the sports sedan that they have in the market right now is outstanding. They have a Gravity SUV they just unveiled that I got to see a couple days ago that will help drive sales as you get late into 24. They probably need capital a little bit sooner than Rivian does. Which is one of the things that has kept us on the sidelines on Lucid right now. And then their sort of mid-size, probably more volume-driven vehicle is several years down the road.
All right, Steve.
The other, just one other quick point there is, the one other quick point there that's worth noting on Lucid, the Saudi PIF fund owns 60% of the stock. They have a large order and manufacturing facility going up in Saudi. So they have a very wealthy shareholder/partner that's behind Lucid, which I think will help the funding get.
Stifel's Stephen Gengaro. Stephen, thank you so much for joining us today for that time, insight, and stock picks. Appreciate it.
Thank you.
And coming up, November's jobs numbers look very similar to pre-pandemic levels. Is the economy finally normalizing? We'll have more on that after the break. Wall Street is debating when the Fed will start to cut rates and whether the U.S. economy will achieve a soft landing. But in terms of the health of the economy, there may be an easier way to evaluate it. Recent economic data show the U.S. economy might be finally getting back to a pre-COVID normal. Yahoo Finance's very own Rick Newman has the story. Rick.
Hey, guys. So we got 199,000 new jobs in November. I looked up what was the average monthly job creation during the 8 years prior to the COVID outbreak in March 2020. Guess what? It was 196,000. So only 3,000 difference there. And then I looked up, well, what was average wage growth when you adjusted for inflation in those 8 years prior to COVID? It was about 0.8% per year. Guess what it is now? 0.8% per year. So job numbers are now looking like they did before COVID. And I think that would be great news for everybody if we could just get beyond all of these distortions in the economy that were caused by COVID, including inflation, and get back to what just feels like a normal economy where we're not always trying to figure out why are things so weird. Inflation is not there yet. The pre-COVID average was around 1.6%. It's around 3.2%. But that has been coming down, as we've been discussing quite frequently. And in fact, we got another good read today in the Michigan Consumer Survey, which asked people what they think inflation is going to be in the future. And Americans are a lot less concerned about inflation than they were just 4 months ago or 6 months ago. So I think we're getting back to a normal economy. We're not going to have gangbuster 5.2% GDP growth like we did in the third quarter. But, you know, if the economy chugs along at 1% GDP growth, 1.5%, 2%, which is where we might be landing right now, I think that would be great.
Well, as always, Rick, we got to ask you, what are the implications for the president and his reelection campaign, right? Because as we've frequently talked about, inflation is kind of the thing that voters seem to grade him on.
So if we could get into an economy that feels normal, and I emphasize that word feels, because the squishy part of consumer psychology is really important here. I mean, we've discussed this many times. People just don't think it's a solid economy. They think it's terrible. And by some measures, consumer attitudes are recessionary. I mean, they're close to the lows of the financial crash in 2008 and 2009. The economy is not nearly that bad. Americans are way too gloomy. So if they can start to feel better, I think it would be unambiguous good news for President Biden. So, you know, we've had super strong job growth under Biden. I mean, he is right when he says it's the strongest job growth of any president in U.S. history. That is correct. And that doesn't mean Biden deserves all the credit for it. He happened to come into office just as this super strong COVID recovery was coming into place. But if we could enjoy all that job growth, let all that job growth sit there, let workers regain some of the ground they've lost to inflation when inflation was higher than wages, and it is now flipped around. Wages are now higher than inflation. I mean, yes, I think you would see people gradually feeling better. I mean, Biden's in kind of a race against consumer psychology at this point, with the race being whether consumer attitudes improve enough to push up his approval rating, which of course has been very depressed around 40%. He needs it around 45%, and higher would be better for his reelection odds. So that's what I'm looking for the next 6 months, is whether we see his approval rating start to creep up as the economy normalizes.
Look forward to talking to you about it as you watch it. Rick Newman, thanks.
Bye, guys.
Well, information from the monthly jobs report is rolling in today, but a new study published by the Federal Reserve Bank of Boston suggests jobs data may be leaving out millions of gig workers. Here to talk more on the gig economy following the jobs report, we've got this Kennedy Center Senior Employee Policy Analyst Matt Darling. Matt, it's good to see you again. This is an area of the workforce that sometimes gets overlooked in the data. So what do we know about how gig workers are doing?
Yeah. So I think one thing with gig workers is it's always really hard to count them. One of the questions we always have when looking at this sort of data is, what actually is a gig worker? And sometimes when you run surveys on people, it's a little bit hard to tell what they mean, right? So if you ask someone, are you employed full time? If you have someone that is maybe working from the house, selling something on Etsy or similar, they might say, oh yeah, I don't have a gig job, because that's not how they conceptualize it. So it's one of those statistics that's really, really hard for us to keep track of and maintain. And one of the things that's sort of interesting is looking at this over time is that a lot of times we've thought that there's been a huge increase in gig workers, and then when the Bureau of Labor Statistics and other folks look at it, they don't really see that. One thing that I think is really sort of fascinating is that right now we've got one of the a really, really low amount of people who are working part-time. I think it bumped up a little bit in the most recent job report from, I think, 17 to 17.2, which is still, well below the 2018, 2019 levels that were around 18%.
And Matt, another question I had about the gig economy. Do we have insight into the demographics of the gig economy? Who's working in the gig economy, and has that shifted at all?
That's a great question. It's hard to say, especially just because, like I said earlier, we don't have that Granted Good measures in the first place. I do think, in general, what I would expect to see is similar to the difference between full-time and part-time workers, that I expect to see, more people who are African American, Hispanic, non-white populations that are participating in that. People who are often shut out for one reason or another from the full-time labor market.
And there's also some talk about retired people, who are sort of pushing off retirement and maybe doing gig work in the meantime, right? But I guess, again, to your point, it's difficult to get good empirical data on all of this.
Yeah. I mean, one thing that we definitely saw during COVID especially is that a lot of people who are, not necessarily retirement age, but near retirement age, 55 plus populations, definitely were leaving the labor market at that point. And over the last year and a half, you can sort of see them rejoining, especially that sort of 55 to 65 year, whereas people sort of said maybe, during COVID, both because of the actual risks of working, but also, just because of, it was so hard to find a job for a while, that was maybe a really good time to say, hey, I might take some time off, maybe I'll consider retiring. And then hopefully, what we're seeing is wages pulling people back in as the labor market sort of gets healthy. It's unlikely that that we're seeing that much more in older populations that are rejoining because their income's gone down, just because we know that most people's assets have been pretty healthy.
And Matt, I want to get you out of here on this, just get your take on that, the big jobs report we got this morning, Matt. I would just love to hear what you made of that report, and also just what you see, Matt, for 2024 for the U.S. labor market. Do you think it stays strong? Do you think, jobs growing, wages growing? What's your outlook?
No, it was a great jobs report. Anytime you see unemployment decline, prime age employment go up, that's great. One thing I always like to pay attention to, especially right now, is disabled employment, which was 22.9, just short of the all-time high in August. So I think it was a really good jobs report. And I think, to your question about what is it going to happen in 2024, it is that Federal Reserve pivot, right? That they've been sort of putting a little bit of pressure on the economy, raising interest rates, cautiously the whole time. And I think the big question that a lot of us are paying attention to is, when are they going to pivot? Larry Summers recently said today, they should really pivot when they see overwhelming data that inflation has completely cooled down. I'm not that. I'm a little more cautious on the other end, that I really don't want to see the labor market, which has been so strong, I don't want to see those really hard fought for gains go away.
Matt Darling, thank you so much for joining us today, Matt, and have a great weekend.
Thank you. You too.
And coming up, Elon Musk taking a legal battle with the SEC all the way to the Supreme Court. Going to have all those details after the break.
The U.S.-China chip war has put big tech in the crosshairs this year. Now, as we look ahead to 2024, who are the winners and losers? And what are some of the other key issues that investors need to keep on their radar? But joining us now, we want to bring in Jiang Shao. He's at Barclays, a China tech analyst. Jiang, it's great to see you here. Thanks so much for taking the time to sit down with us.
Oh, thank you for having me.
So let's talk about the escalation that we've seen between the U.S. and China with the chip wars, the back and forth right now. How effective, or I guess, what's your assessment of the impact so far?
It's a very complex issue, right? In the near term, nobody is a winner. Everybody loses. You see the CEOs of NVIDIA, Intel, and AMD were in Capitol Hill not long ago and saying, hey, the leading American semi companies are losing billions and billions in revenue, which we can reinvest into R&D so we stay ahead of the curve. Right? For the Chinese companies, also they're being hurt as well. Like Alibaba recently, as you know, canceled their IPO for the cloud unit because of the limited access to the latest and greatest chips from some of the US companies.
Has it been effective in terms of what the U.S. is trying to do? They're trying to limit China's access, yet we have seen, and we saw the first sign of it this summer with Huawei with their smartphone, just in terms of not really being able to slow down some of the innovation there.
We have done studies, and we have concluded so far that the export control and technology ban usually doesn't really that work very well. As you can see, to everybody's surprise, Huawei came out, have the Mate Pro 60 phone with a 7 nanometer. And the industry chatter is that they're going to have 5 nanometer within 12 months' time. So they're not that far behind of the US companies. And in a way, the US regulators put the Chinese company to the corner. In a way, counterproductively accelerated their own development effort. So again, we think long-term repercussion is far from clear. But near term, it seems to be everybody is in a lose-lose situation.
Who could potentially be a winner here in that longer term horizon? Is there anyone that you think could potentially be positioned better than others?
So far, companies like Huawei appear to be winning, right? They were sort of handicapped 3 years ago when TSMC stopped making chips for them, and their market share in the cell phone went from 30% in China to 0. Now the new phone came out 3 years later. To longer term, some of these Chinese companies may actually eventually become a winner out of the chip ban. So we are concerned that the US companies, in the near term, they seem to be hurt. We're worried in the long term, they may be hurt as well.
Jiang, you taking a step back here and just taking a look at what's been playing out in China over the last several years. We've been waiting for a recovery post-pandemic. That recovery has been much slower than many of the forecasters had initially anticipated. You cover a lot of the larger cap Chinese tech names. What is your outlook in terms of the fact that how quickly they could potentially recover as we look ahead to 2024? Because a lot of the larger names are still under a tremendous amount of pressure.
Yes, and their fundamentals actually are not doing as badly as their stock price have been doing. So China has had a difficult 3 years. I mean, COVID is just one of many, many problems they have had to deal with. And now the economy is slower than a lot of people hope. And now the government has started to loosen up a lot of the restrictive policies, for example, in the area of real estate. They are now, in a way, pro-business now. I mean, 2-3 years ago, the Chinese government came down hard on some of these internet and tech companies, right? They kind of, in a way, killed the education industry nearly overnight. And they took away the power and incentives of entrepreneurs. Now, hopefully, they have realized you can't really have a vibrant economy without these entrepreneurs, without private-owned enterprises. Now, she was just in Shanghai last week. I think a lot of people took that as a sign that perhaps the most senior leadership in China now is perhaps a bit more pro-business now. We do have relatively optimistic view for China for 2024, and we start to see the green shoots of that recovery already.
What's it going to take, though, to win back investor confidence? Because you mentioned the fact that, yes, the government seems much more pro-business than they had been in past years. But in terms of winning back that investor confidence, what do you think that timeline looks like?
Hopefully it's going to happen next year, and it's going to take a lot to win back investor confidence. I'm just thinking out loud that make an IPO happen, right? the cancellation, the last minute cancellation of anti-IPO 3 years ago, was the beginning of the current downtrend. Make enter financial IPO again, stop meddling too much about the industry in terms of regulations. Let the businesses do what they do the best in terms of innovating, not just on the technology side, but also on the business model side, and protect global investors' interest. Do not come up with these draconian regulations overnight, could destroy our industry overnight.
Xiang, as we look ahead, 2023 has been a wild year for tech when we keep in mind some of the top themes and some of the movement that we have seen in a lot of these larger cap US tech stock names. As we look ahead, though, to 2024, what's your top investment idea?
Depends on your risk tolerance and your investment style. I think if you say, hey, I don't own any Chinese companies, I want to own safe and sound businesses, and we will say Tencent, right? Tencent is doing great. And all their three major lines of businesses are recovering very nicely. Gaming is going to be awesome next year because last 3 years was terrible. Chinese government restarted approving new games again. Their advertising business is on fire because they added new inventory to their advertising business, and also they upgrade in a meaningful way their ad tech and their payment business. The WeChat payment is doing very well. So I think Tencent will be a pick for that kind of style, for that kind of investor. If you are pro-growth and have a little bit of risk tolerance, we like PDD very much. And we think the Temu business, which is the cross-border business, may change the landscape of e-commerce globally and will have sort of wide-ranging impact on companies around the world. And they launched a bit over a year ago. Now their GMV this year is reported to be close to or above $20 billion. And if you are sort of a value investor looking for best reward for the risk you are taking, we think Baba remains a very, very attractive investment. People are already very familiar with the challenges Alibaba has been dealing with, but people often overlook the fact that this company made $27 billion free cash flow in the last 12 months alone. You are paying 4 times of free cash flow, and when you even ignore everything else they own, even if you give zero value to the cloud, to the logistics business, you're paying 4 times of free cash flow. And they're giving you $2 billion dividend, and they're buying back $10 to $12 billion cash stock a year. That's very good a return to shareholders.
That was Barclays China tech analyst John Chow looking ahead on the state of tech. Meanwhile, Elon Musk taking a legal battle to the Supreme Court. The billionaire CEO of Tesla appealing to the High Court to terminate his settlement with the SEC regarding his 2018 tweets about taking Tesla private. Yahoo Finance's Alexis Keenan has the details. Alexis.
Hey, Josh. Yeah, a little bit of a trip down memory lane here. This is a petition by Elon Musk asking the Supreme Court to take up his dispute with the SEC over the settlement agreement that he reached with the commission in 2018, over that 2018 tweet, I should say, where he said he had funding secured to take Tesla private at $420 per share. Now, this is all in an era before Musk bought the company in 2022 with his own $44 billion plus some loans, where he was being charged with stock manipulation by the SEC. And to settle that problem, Musk said that he and Tesla would agree to $40 million in fines, also to step down from the board as chair. But importantly, he agreed to have his statements, his tweets, his material tweets reviewed by somebody at the company before they go out. Now, Musk says the SEC, and therefore the government, is using this agreement to infringe on his First Amendment protected free speech. He also says that the conditions of this agreement go way too far. In this petition, his lawyer calls the agreement an unconstitutional muzzle. He says that chills Musk's speech through never-ending threats of contempt, fines, or even imprisonment for otherwise protected speech. Now, since entering this accord, the SEC has asked Musk and the company for information 3 different times for information on tweets that he put out that they want to call potentially into question. And so far, there are 2 lower courts that have both rejected his argument that this agreement is unconstitutional. You had in May a New York appellate court affirming a district court, a lower court's ruling, declining to undo this accord. But in February, January, really interesting, Musk won a California jury trial over that same very tweet. The jury in that case said the tweet didn't amount to stock manipulation, and therefore that freed Musk from any liability to shareholders. Now, the SEC is also investigating Musk over his 2022 purchase of Twitter. They sued him in October to try to ask whether or not the statements that he made in that arrangement were not on the up and up, and that he may have manipulated stock in that instance. Josh?
I'll take it. Thanks so much, Alexis. Have a great weekend.
You too.
Coming up, Krispy Kreme opening the doors to its first store in France to a very happy reception. We'll get into the expansion details after the break.
Welcome to Yahoo Finance's group chat. I'm Josh Schaefer here with Praz Subramanian and Alexandra Canal. We're taking a look at some of the top stories of the day that caught our eye, and I want to take a look at Lululemon shares. They reversed losses earlier in the day, reaching a record high after reporting earnings after the bell last night. They beat on the previous quarter on revenue and earnings per share. Now, the guidance did come under question a little bit, coming in a little bit lower than Wall Street had expected. The range for both EPS and revenue slightly lower than expectations, but it seems like overall the street, as they started to digest these earnings, said, okay, they think Lululemon's in pretty good shape overall, and also a lot of people noting that they think that Lulu might have been perhaps intentionally soft, so to speak, on that fourth quarter sales guidance, just to sort of see how the holiday quarter plays out, and they think that Lulu might end up upping that guidance for the fourth quarter before they actually report. So sort of the street coming in and saying, all right, now that we're really reading through this, because shares were down last night after the bell, actually a pretty good print.
Yeah, just really bullishness across the board here from the street, which is helping to lift those shares. And Citi, echoing what you said, thinks that conservatism was baked into some of that guidance. They also added that Lulu is still a market share winner, with the brand doing very well in the US, continuing to do well in China with the potential of outsized growth ahead. And then I thought this was interesting. Wedbush was out with a note saying that they're continuing to focus on men's. Now, men's business did grow 15%. That was a bit slower than women's, which came in at 19%, but still very solid. And then if you think about all the brand campaigns, the strong growth overseas, there's a lot of potential for the men's market. And I think about being a girl and all the options that we have out there for athleisure. It's very fragmented, where for boys and their Lulu pants, they're obsessed. They love them. So I think there's a lot of opportunity there. You being one of them.
Well, yeah, I am a big wearer of Lululemon. I'm wearing the pants right now, as I often am when we talk about them. But it gets to a point, too, I think it was Wedbush pointed out that competitors had been promoting, right? Like Aloe had been running a lot of 30% off sales. I shop at Lululemon. I don't really shop at Aloe because I don't think Aloe has the comparable to like the ABC pant that Lululemon has, right? Or the Lululemon's dress clothes and dress shirts. Like Aloe is a yoga brand. Right. Which Lululemon is, but Lululemon is built beyond that. So I wonder if those promotions we're seeing sort of across the market will impact them to that same extent because they could be different products.
They didn't do a ton of sales. I was looking.
Yeah, I mean, historically, right? Sales is kind of like not their thing. It's you might find some discontinued
and their stuff is expensive. So even the stuff that was on sale was expensive.
Right. It's like $100, $90, right?
Yeah, exactly.
Just real quick, I just want to note that China sales, like you mentioned, up 53% year over year. It's huge, right? So big growth story there. So let's stick with the high-end retail sector, a little bit more upmarket to luxury, where we thought those well-heeled buyers were immune to economic headwinds, but Bain & Company finds that the luxury sector is only going to grow at half the clip it did in 2022 when it rose by 15%. You know, I'm kind of also honing in here more on beyond luxury. Like this is sort of like we thought that the sales there were pretty robust, but I'm honing in on actually the high-end watch sector here. The Bloomberg Subdial Index tracking the secondary market fell in November, fell 10% year over year. The high end kind of feeling the pressure here, even like new market getting some pressure here as well. Swiss watch exports falling. You know, I got to say, you know, is it now the time to buy, right? Or is it what can help the luxury market? Is it, you know, this report talking about how rate cuts, we need the rate cuts, right, to get that market back up. But what do you guys think?
I mean, you get rate cuts come, if you're just thinking about different ways that people get capital, right, and then spend it on something like a watch. You just had the S&P 500 hit a 52-week high, right? You do have the potential for rate cuts coming. You can see sort of maybe some of those tailwinds. So does crypto's up.
Silver lining, yeah.
Yeah, I mean, like when Bitcoin was up really high 2 years ago, right? Wasn't that something that people sort of said, people are taking crypto money and buying watches? So you wonder if that starts to play out. I'm excited to go shopping personally, and maybe.
Yeah, I mean, we've
have Prost pick something out for us.
Yes, we've seen this resilience in the luxury market really for the bulk of 2022. Even this summer we were talking about it, and then there was a quiet luxury trend that really took over Instagram and TikTok, and now we're seeing that sort of pull back. So I do wonder what the ramifications are moving forward, especially since all these brands with their inventory piling up, they don't do sales. They don't want you to see that this Prada bag is on sale. They want to keep that exclusive nature, and that can be a problem when you think about the inventory.
Right, and real quick, one thing mentioned in this journal story mentioning this Bain report is that discounting has never been a thing for the high-end luxury brands, but selling to outlets and having them discount is one thing that they do. So you might see more and more of these high-end things discounted, like not at Prada store, but in Marshalls or wherever else.
We'll go to the AC outlets.
Weekend
Atlantic
plans
City
for
outlets. I go there often. It's great. All right, another story we're watching today is Krispy Kreme, the company opening the doors to its first store in Paris as a donut chain. Also plans to open more locations in France in the coming months. And this comes amid a pretty big international push for Krispy Kreme. They were recently speaking at a conference earlier this week. Their COO and global president saying that franchise markets is where they're seeing a lot of this new growth, and that Europe really serves as that high growth opportunity along with Japan, Canada, Mexico. And I think about all of these US-based restaurants and chains, from your Starbucks to your Yum brands to your McDonald's, that do really well internationally. I wonder how that will translate with Krispy Kreme. Personally, if I'm in Paris, I'm not having a Krispy Kreme donut. I'm having a croissant. So I don't really know. But, it's certainly a play, and that's what all these companies are trying to take advantage of.
With regards to Krispy Kreme, I was surprised here. 400 people were waiting in line. They told CNN that on Wednesday morning. People were waiting the night before to get these donuts. I'm shocked.
The Europeans, they love.
I know, but they have so many great bakery options, right?
I agree. I would never.
Yeah, but they're different things, right? And I really do think what you were saying about just American fast food in general going into these international markets and doing well. It's a different taste.
Yeah,
it's like when you go on vacation over there and you have all those great things, and then sometimes you come back and you kind of want the burger, right?
Well, sometimes McDonald's,
you want the American.
They say it's better in Europe.
Yeah.
It's because they just have different products and they cater specifically to that market.
But also power of American brands, right?
Right.
McDonald's, even Popeyes in France and now.
Krispy Kreme with the hats.
Yeah.
I mean, that's an international brand alone, right? Just the hats, good donut.
Yeah, I mean, again, I'm having the croissant over the donut, and I'm going to say it like that continuously.
We'll debate that off air when we shop for our Rolex.
Yeah.
Le Krispy Kreme.
Yeah, exactly.
But coming up, we're going to tell you what to watch next week. We're going to break down the stories you need to know headed into a big Fed week next week.
Microsoft's partnership with ChatGPT maker OpenAI under scrutiny from antitrust regulators in the UK. And this coming as the FTC is now reportedly examining the nature of Microsoft's investment in OpenAI. That's according to Bloomberg. Here to discuss Yahoo Finance's Dan Howley. So Microsoft sort of seems to be saying, well, we don't have control over OpenAI, so it's okay.
Yeah, that's right, Julie. They own 49% of OpenAI. They have a non-voting observer seat on the board of OpenAI. That was after Sam Altman returned to the company following his ouster. And so, yeah, as far as they're concerned, they don't have any real leadership role at the company at all.
And Dan, so where do we expect this to go from here?
It's going to be difficult. You know, I mean, the main thing here is that the Competition and Markets Authority in the UK is trying to examine specifically if there's a relevant merger situation going on between Microsoft and OpenAI, meaning is this tie-up bigger than just, you know, an investment? Is Microsoft is OpenAI really kind of an arm of Microsoft at this point? They are using a lot of their software in their co-pilots. They are marketing themselves as the big backer of OpenAI. OpenAI, the CEO, Sam Altman, was almost hired by Microsoft. Satya Nadella reached out and said that they would hire him. And most of the staff of OpenAI was willing to go to Microsoft during the ouster that had occurred. So, you know, the CMA is looking into this now. And then, as you pointed out earlier, Julie, the FTC is now sniffing around trying to determine if there's some kind of practice going on between the two that could be untoward. So, you know, they're both investigating. Nothing is you know, fact now. There's no wrongdoing or anything along those lines. But it is, you know, if you're looking at Microsoft, you're looking at OpenAI, you just got past this shakeup at the highest levels of the company, and now you have antitrust regulators circling.
Yeah, and speaking of that shakeup, it's also interesting because this circling is happening at the same time that there are increasing media reports trying to shed some light on what really happened during that shakeup at OpenAI, because it still seems pretty opaque. The Washington Post, the latest today, it's out with a story looking at what kind of manager Sam Altman has been. And you have to wonder how that might also sort of circle back and reflect on these investigations as we try to figure out what happened.
Yeah, there's these reports from the Post basically saying, that Sam Altman had played employees against each other, that there was a toxic environment, that there were issues with board members, specifically a board member who had submitted a report that was critical of OpenAI, and then there was back and forth and acrimonious relationship with the board member and Sam Altman. So, there's this starting to get some idea of what was going on there beyond just the Altman wanted to push the kind of product of AI over the safety that OpenAI had kind of been pushing. So yeah, there's more coming to light, and I believe it was Amazon had spoken out, basically saying, look, we have multiple companies doing AI work with us. We're not beholden to just one. Basically, I mean, it's clearly a slap at Microsoft and OpenAI. So, if you're Microsoft at this point, you're seeing these reports. You're seeing that there's regulators looking around. I mean, the investment in OpenAI, the $10 billion over several years, there's certainly got to be questions about what's going on there now.
All right, Dan Howley, thank you as always for joining us. Have a great weekend. And time now for what to watch next week. On the earnings front, Oracle, Adobe, and Costco among the key names reporting next week. For the software giants, investors will be watching for updates tied to artificial intelligence and the cloud. As for Costco, it's all about the consumer and whether the warehouse retailer sees weakness for the current quarter. Shifting to the economy, investors bracing for the next look at inflation with CPI data coming out on Tuesday. Analysts forecasting a slight increase for November. Also on the calendar next week, PPI and retail sales. But the big event, of course, of the week, that's going to be the Fed's last policy meeting of the year. Fed Chair Jerome Powell will be giving a news conference after the decision, but the market wildly expecting the central bank will hold rates steady. And ahead of all that, on Monday, Yahoo Finance will be revealing its Company of the Year. Get your guesses in now. The big announcement coming at 9 a.m. Eastern on Monday.
Well, that'll do it for today's Yahoo Finance Live and this week's Yahoo Finance Live. It's been a good week with the debut of Goodbye or Goodbye, among other things. Join us back here Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a great weekend.